Good morning. Today is Tuesday, October 10th, 2023. I'm Joe Terril, president of Terril and Company, private wealth managers in St. Louis, Missouri. It's time for another investment update and what we are thinking. With me today is Dallas Whitaker. Dallas is senior vice president at our Springfield, Illinois location and a member of our investment committee. Of course, David Carter, who's more than 20 years with Terril and Company as a portfolio manager and research person here in St. Louis. And Russ Phillips, who has joined us in the last year, again, a 20-year plus veteran. And we thought it was time to do an update because we've had a terrible tragedy in the Middle East that has changed the thinking of some market participants, and we wanted to talk about how we see this and what we intend to do with our managed portfolios. So with that said, let me maybe set the table before I turn to one of the other members of the investment committee and say how terrible this is for families and people in the Middle East, and our thoughts and prayers are with everyone, and we hope that somehow this tragedy can come to an end before there's more loss of lives. With that said, markets, there's a number of dynamics playing out right now, and I'm going to turn to you in a minute, Russ, to explain that for our viewers. But in general, there are some market participants who believe this tragedy is going to slow down the world economy, thus inflation is going to come down, thus interest rates all over the world are no longer going to go up, and we tend to be unwilling to jump to that leap of faith that somehow a war, if you will, in the Middle East will end up being good for markets. No. Anytime we don't have world peace, it's not good for markets. We can see that by Russia and the Ukraine, and now potentially this issue in the Middle East is liable to spread into a bigger issue. That's not good for investment markets, period. World peace that gives people productivity, that gives people production, that is traded and sold with each other all over the world is much better. But Russ, let's talk maybe first a little bit about where we're at right now with markets. It's what I call the stock market has been camouflaged this year. But explain to viewers what we mean by that when we talk about it at our investment committee, and give them some figures, if you will.
So Joe, I appreciate the question. Basically, our thesis has been the fact that rates are going to stay higher for longer and stocks would struggle. And I would say that thesis has been correct, with the exception of a few what we call the Magnificent Seven stocks. Some technology stocks really kind of focused on artificial intelligence have done well. Also kind of in the healthcare field, any stocks tied to weight loss drugs have performed very well. Outside that handful of stocks, the normal stock has not done quite as well. A couple of figures that I would give you. If you look at the S&P, there's an ETF that's the S&P Low Volatility ETF. Measures stocks that basically aren't as risky as the overall S&P. That index year to date is down about 6%. So consumer staple stocks, utility stocks with the rising interest rates have not done very well. You put into that basket as well the small cap stocks as measured by the Russell 2000, flat year to date. Finally, S&P 500, we have an equal weight index called the RSP, that's an ETF. That index is basically flat as well. So the majority of stocks in the indexes are down, flat to down, whereas a handful of stocks are really driving the indexes this year. So we look at that as an opportunity, and in this tax loss selling part of the year, we're probably going to be taking advantage of some of those opportunities.
David, I'm going to come to you in a moment, and I want to expand on that a little bit and what our intentions are with stocks. But before we do that, Dallas, let me go to you on this fixed income world. Let's talk about what we're expecting there and what we see happening. And as most of our clients and people know, we've stayed ridiculously short with all our maturities. But Dallas, let's talk about fixed income and what we expect there with bond prices.
Sure. Thanks, Joe. Well, the last 2 years we've seen what really equates to a meltdown on bonds with maturities beyond 10 years. As we know, interest rates rise, existing bonds have a tendency to fall. The longer the maturity, the harder the fall. So by staying short, we've been able to continue to make money on the fixed income side. If somebody has a balanced portfolio, when stocks started to fall, the bonds that were supposed to be buoying up the portfolio in a falling stock market did exactly the opposite, because with rising interest rates, they fell along with the stocks. So what's nice about being short on our durations, we're still making money on the fixed income side. We're able to sit and wait until we have the right opportunities. And so those people who are looking when a market turnaround to get their portfolios back to where they were able to build on what we were able to preserve during that time.
So if I would have 2.5 years ago refused to accept 0 to 1% on money market funds in short-term investments and said, no, I'm going to go buy a general bond fund, or I'm going to extend my maturities, where am I at now 2.5 years later?
If you try to lock in long-term maturities back then, you would see a significant decline in your portfolio value just because of the way the bonds are selling in today's market.
How much am I down? 10, 15%?
At least.
The longer you have, I read something the other day that said if you went to the extreme and bought 20 and 30-year bonds, you're down as much as 50%. Is that correct on Treasury bonds?
That is exactly correct. And in fact, Treasuries have seen some of the biggest meltdown.
So we're keeping our portfolio short. What do we think is going to happen with short-term interest rates and long-term interest rates? Have they peaked, or what's going to happen here?
Well, that's a really good question, because if they haven't peaked, they've got a little bit longer to go, but that means that we're still going to see a level interest rate environment for a period of time, which gives us time to be able to position ourselves, look for the bargains, not have to get into a hurry, and still earn great returns on fixed income portfolios in short duration.
So longer-term bonds right now still yield less than the short-term market. We've talked and talked and talked about it. I think we're in agreement that the long-term rates are going to continue to go higher until they equate with short-term rates. Therefore, they're going to continue to go down in price. Therefore, we're going to continue to stay short in our maturities.
Right, and then once we actually start seeing it turn around, we'll be able to lock in some of those longer-term rates, and that'll be a good buying opportunity at that point in time when interest rates start to fall.
Dave, let's turn to what Russ was talking earlier about, in general, stocks had a horrible year last year. If you throw out a few high technology stocks that because of market capitalization dominate the averages, you throw them out, this is another down year for the stock market. Explain to our viewers, if you will, what we intend to do maybe between now and the end of the year, now that stock prices are down as much. Maybe you can even mention a few names.
It's really an interesting time to be an equity investor. Interest rates have, interest rates are the pricing mechanism of all equities, and the sector that got hit the hardest is the financials, and that really intrigues us because you can now buy a Bank of America at book value. You can buy a U.S. bank, at book value. Some of the other you can find some of the financials trading below book value. 3 years ago, they were 170% of book value, and that's all due to interest rates. The materials stocks, oil, steel, fertilizers, chemicals, those are all down significantly due to some concerns over recession fears. Those companies are all generating good free cash flow, and they are, if the economy stays strong as we expect it, those companies are in prime shape to perform well. We like the gold sector. Central banks are a net buyer of gold. Companies are generating free cash flow. They're going to be paying good dividends. We think that sector looks awfully interesting. And then selected technology stocks look awfully interesting that have sold off because of the higher rates out in the market. We like a Coherent. We think that looks awfully interesting, a name we've owned before. And then one that really sort of is intriguing is Disney. Disney is back to its COVID low. And there's some extracurricular activities going on there now with some activist investors, but there appears to be a lot of value, sort of hidden value there. And what happens to some of the parts, time will tell, but we think the content is significant enough to create value. So there's some sectors and some names that we're interested in, and I wouldn't be surprised to see those in portfolios by the end of the year.
Good. So we anticipate maybe increasing the percentage held in stocks where we've been underweighted for 2 to 3 years now by maybe 10, 15, maybe as much as 20%. Now that prices have had significant pullbacks and they're selling at what we think now are finally bargain prices. So with that said, we'll be back with an update as needed. And Brian Curtis, who produces these videos for us, thank you, Brian. And we'll be back as needed, if not in probably 3 weeks' time. Thank you.